Well, thank you very much for joining us today for our presentation on the 4Ds, why the structural growth market can continue. My name is Kurt Polk and I'm president of Axiom Investors. A few housekeeping items. Today's presentation will be 45 minutes of prepared remarks and 15 minutes for Q&A. Please feel free to submit questions throughout the presentation. Simply use the chat feature on the toolbar. The slides will not be distributed, but this webinar will be posted on our website, axiom-investors.com. Please read the following disclosure, and the strategy disclosures are found at the end of the presentation and also on our website. I'm very pleased today to introduce Andrew Jacobson, Axiom's founder and CIO. Axiom was founded in 1998, and we have steadily built our employee-owned firm to $16 billion in assets under management and 50 teammates. Since inception, the investment team has implemented a forward-looking dynamic growth philosophy and process focused on investing ahead of the curve. I do hope you enjoy today's presentation. Andrew?
Thank you, Kurt. And we have a lot of material to cover, and so I'm going to dive right in. But we have really received a tremendous number of questions from our clients regarding the outperformance of growth and whether or not the structural growth market can continue. And it's truly on everybody's mind. And just an anecdote as a point of departure to frame the issue, it's really notable that just in the last week or so, Warren Buffett, the preeminent value investor really of our generation and of the last extended period of time, has decided to begin to liquidate his banks at 1/2 of book value and reinvest some of the proceeds into Snowflake at effectively infinity times book value. And it says something about where a very astute value investor perceives value looking forward. So with that, I'm going to just dive into the current environment, what's precipitating these questions, the context in which the questions are occurring, and then our view of equity markets and specifically growth versus value. So I'm just going to jump right in, the backdrop. So this is what's precipitating all of the questions. We've been through an exceptionally volatile market period. So this year's market moves have been really quite historic. And so if it feels unsettling, that's certainly consistent with the data. So what you're looking at, and we're going to try as much as possible to show long-term perspectives. So this is a 50-year perspective on world market sell-offs and recoveries. And the blue line is the typical trajectory of a market sell-off and recovery, both in the months preceding and the months following a sell-off, with the light blue zone that you see around that dark blue line, the plus and minus 10th and 90th percentile zone. And this year, as you can see, the sell-off has been very outsized, and so is the recovery. And in both cases, both during the sell-off and during the recovery, growth significantly outperformed. And again, what that's meant, just moving forward, is that a lot of investors, after a period not only of outperformance by growth this year, but over the last decade and even slightly longer than a decade, a lot of investors are presented with charts that look something like the two that you see on this page, with an extreme kind of PE relative valuation. Sometimes you'll see price to book, but it's the same picture. So I think that the pictures present the situation well. So these charts show both for the world growth versus value over the last 10 to 15 years, with growth now trading on a historically high relative valuation. And so this is typical for the kind of chart that you'll see when people are arguing that you should rotate back into value. There are a lot of opportunities to have that discussion because we're in a period of extremely noisy short-term factor rotations that frankly distract from seeing the bigger trends. And so what you see on this page in the colorful chart is something we follow closely. It's a Bloomberg screenshot of growth versus value on a daily basis for the last 20 years since MSCI split growth and value. So it's the MSCI world growth versus MSCI world value. And when the green line is high and above, that means growth is outperforming. And when it's red, that means value is outperforming on any given day. And just to put this in perspective, to give you a sense for how dramatic these moves are, plus or minus 100 basis points, that's essentially a 2 standard deviation move. And so you can see those are occurring very frequently, much more frequently than perhaps you'd expect. And plus or minus 2, that's a 4 to 5 standard deviation move. And so these are very exceptionally violent rotations. It has something to do with market structure and passive investing. But in this context, it constantly precipitates this question, should I be rotating into growth or value? And what's the context in which these rotations are occurring? It's very important also to take a long-term perspective, because if you get caught up in the daily fluctuations or even the relatively short-term fluctuations, a kind of a growth peak to a value peak or vice versa, you can really miss the broader trends. It's important also to realize in understanding the context that it's not just growth that appears expensive. All equities are now expensive on PE and on other valuation metrics as well. And so this is an analysis of a variety of different categories of equity, in this case done by Goldman Sachs over the last 10 years. The blue zone is plus or minus 1 standard deviation with tails to the extremes. And you can see in every case, whether it's cyclicals, defensives, financial staples, importantly, value or growth, emerging or developed, in every case, equities are at the extreme high end of their valuation ranges. And so if somebody tells you that value is cheap, that's a very misleading statement, because value is not, in fact, cheap at all. In fact, value is at the 97th percentile on PE of its historic range. So there's something broader going on, which is increasing the general valuation level, and we'll get into that in just a moment. And it's not just public equities. One reaction to the volatility and moves in the public markets has been to chase into private equity. It's become, I'll say, a fad. But when you get investor crowding, you actually get valuation spikes. And so this analysis on the left is private equity versus public equity. And private equity has now gone to a premium in this analysis by Stratagas, a dedicated economics firm, on cash multiples to public markets. Perhaps that's part of the reason now that 70% of the private companies that enter the public markets actually underperform the public markets because they enter the markets potentially overvalued. So what that's meant in terms of returns for private equity is over the last decade, not only has private equity on most studies struggled to outperform public markets, but to the extent there has been performance, and this is from Bain does a very elaborate annual study, most of the performance in private equity has actually come from this valuation expansion, which has now reached kind of an extreme. So private markets, public markets, both highly valued, and it's not just equities, it's actually bonds as well. So again, in the spirit of long-term perspective, this is 120 years of equity and bond market valuations, in this case, Case-Shiller. So taking rolling valuations, and US 10-year yields on the left, on the right is the global picture. Essentially, it's inverted. So extreme low yields means high valuations. You can see the percentile of valuation on the left, and both equities and bonds at the historic high of their valuation ranges towards the top percentile. And again, that's not just a US phenomenon, as you can see on the right. Again, 150 years of history. It's a global phenomenon. So these are 10-year yields, long-term yields across all different governments that have the data globally. And we're in every single case right at the extreme of low yields, high valuation. So equities, both public and private, bonds, and frankly, credit. There's this interest in credit. We can talk more about credit, but credit is extremely expensive as well. As you'll see, credit's a little complicated. You have to consider defaults. But a couple quick charts on the situation in credit. So these are corporate bond yields, all investment grade yields from AAA down to BAA. And you can see valuations, which is to say yields, at the extreme low end, valuations in the top percentile in this box here, top half percentile, so extremely high. And those high valuations, low yields, low spreads, excuse me, are occurring despite a rising potential for defaults. So we're seeing, and this is a JP Morgan forecast, but whichever forecast you might choose to look at, we're entering a period of escalating defaults. The downgrade to upgrade ratio now for BBB bonds or for B range bonds is 24-1. So you wouldn't expect to see spreads and yields at the extreme low end of the range. And what that means, and again, this is from a firm that does modeling of fair value of bonds, a Cornerstone dedicated economic firm. They use 2.3 million Monte Carlo style simulations to come up with fair value based on all of the relevant parameters. And the conclusion in red is that in this case, BBB bonds, BBB minus bonds are extremely overpriced, too low a yield relative to what they should be yielding, given the potential for defaults and the extremely low yields that they're offering. So credit's expensive, private and public equity is expensive. The reaction, as perhaps you'd expect, is many investors are hoarding cash. Last time they did this was during the financial crisis, 2009. So this is money market fund assets, as far back as I could find a summary. And you can see we're at an extreme high of cash levels that historically actually has corresponded to an attractive moment to deploy into risk assets. But nevertheless, one reaction to high asset values is to pile into cash. Unfortunately, for capital allocators like the folks on this call, that really isn't a sustainable approach. Plans are increasingly underfunded, and higher returns are more critical than ever. And given that cash has, frankly, negative real yields at this point, the probability that plans achieve their necessary rates of return is extremely low without the inclusion of risk assets. And so this study looks at the largest state pension plans where there's a lot of transparency. The same could be said of virtually any kind of long-term pool of capital. Funding ratios have fallen dramatically over the last 20 years. In the case of the big pension plans, they've fallen from 96% funded back in 2000 all the way down to 68% funded now. And that's because the actuarial assumed rate of return of 7.73% has not been met. The actual rate of return has just been 5.91%. And that gap between necessary returns and realized returns has opened up a funding gap. And again, cash, is not going to solve this problem. We're going to need to make choices between the available assets that offer growth and real returns. So let's take a dive into what is causing this general escalation in valuations of risk assets, equities, bonds, credit, public and private. There are really four key forces that I'd like to talk about that I think are the most important forces that create the underlying conditions that are the foundation for the asset investment environment that we currently are in. And they're laid out here. I'll go through each one of them in order. The good news is these are very long-term secular factors. And once you understand how they are affecting asset markets, they give you an investable framework for thinking about capital allocation, not just over days or weeks or even quarters, but over time periods that really matter for capital allocators, the medium to longer term. So the four elements are, the four Ds are demographics, debt, deglobalization, and disruption. And I'll just address each one of them in that order. Demographics. So what you're looking at on this page 14, is a long-term perspective on world population growth. And this is incredibly important for the valuation of risk assets. And we're coming out of an exceptional period in human history. And so this is a 400-year perspective. It in fact extends back further. It's from the UN. The UN updates this every 10 to 15 years. Each time they update it, it seems like the outlook gets a little more severe and the population growth expectations decline a little bit more, but let's just focus on what we know. This is the 2019 revision. For a very long time, populations were relatively stable or slow growing. During the 20th century, and particularly after World War II, we had the baby boom. There were similar booms around the world, and we went through a period of exceptional population growth, with population growth peaking at about 2.1%. Historically, it was far below 1%, and this created tailwinds for investments. It created tailwinds for economic growth. That population growth actually peaked in the late 1960s, and by the time of the financial crisis, and so it's coincident but significant that by the time of the financial crisis, population growth was approaching a 50% decline from 2% to about 1%. This is going to have profound implications for the valuation of risk assets and for the structural growth potential of economies globally. That population growth rate continues to decline, and in fact, each time these studies get updated, it appears that the outlook gets just a little bit more challenging. And so, for example, in 2020, just recently, a lot of newspapers covered a study by Lancet, the global medical journal, led by a team out of the University of Washington, that updated these numbers with some updated data on, family formation and mortality and longevity and so on, and concluded that by the year 2100, the population wouldn't be 10.9 billion as the UN expects, but it would only be about 8.8 billion, which is to say 2 billion fewer people, and population would peak even earlier than the UN anticipated. And what's so important about population is central governments can't print new 20-year-olds. Every 20-year-old who's alive today was born 20 years ago, and so there's a lot of visibility around this kind of data, and it has durable implications for growth and investments. The implication clearly is aging populations. As populations age, particularly as longevity extends and people expect to live into their 80s and beyond, which is increasingly the case, their savings rate goes up. And as their savings rate goes up, they are more and more inclined to invest in risk-free assets to provide for their retirement. And that bids down the pricing of those lower risk assets, bonds, fixed income. We'll get into the implications of that in a moment. They also reduce their consumption. And as they reduce their consumption, that creates headwinds to economic growth. And it becomes a negative feedback loop, because as economic growth slows down, the potential returns in their savings become more challenging and they have to save more. And so that feedback loop of increased savings and lower return expectations feeds into lower growth potential for economies. And this phenomenon is going to unfold globally. So it's true that Europe will lead the way in bright yellow. And then we'll see, North America, notwithstanding a little bit of immigration, and Asia, and ultimately even Latin America and Africa. And the population aging is if anything, a universal feature of the investment landscape. So demographics, a challenge. Moving to the second D, debt, very critical. During the 20th century, during the period of, we'll call it value add performance, we were in a period of a consumer debt binge. Consumers were growing new families, buying houses, accumulating material possessions. Governments were investing in infrastructure, expanding social programs. We had this tremendous accumulation of debt globally that supported and created tailwinds to current growth, but ultimately has left an overhang. And so if you look at the current situation, even pre-COVID, of global debt to GDP, we're now at multiples which begin to crowd out and constrain future policy options and future growth. Specifically, we're approaching debt burdens at historic highs nearly everywhere. So long-term perspective, this is over 200 years of history of national debt from a variety of countries around the world. And you can see that, and this is, again, pre-COVID, we'll get into COVID in just a second on the right-hand side of this slide. We're almost back, even before the very high spending on policy responses to COVID, at levels of debt only seen during world wars. So this is These peaks that you see here are World War II, World War I, the Napoleonic Wars. So the level of debt is essentially unprecedented in peacetime, and frankly has been accelerated. These are on the right-hand side are some of the policy responses to the COVID shutdowns, with on average about a 30% fiscal and monetary unfunded stimulus over on top of the pre-existing debt levels, pushing these debt to GDP ratios right up to the extreme end of the range. As global investors, we know what happens when you reach these extremes of debt, particularly in the context of aging populations. It's called the Japanification of the world. The money, because there's not enough demand for investment from these, the economies aren't growing quickly enough to absorb all the capital. There's risk aversion because of the potential fiscal implications of these unfunded deficits. And as the money accumulates and is pumped into the financial system, the velocity of that money, the transmission of that money into the real economy collapses. And so this is what's happened in Japan. You've seen a tremendous explosion in money supply, but a corresponding collapse in money velocity as the money effectively accumulates in the financial system and doesn't transmit through to the real economy. And contrary to Milton Friedman, it doesn't result in any inflation. In fact, the headwinds become ultimately deflationary. So those overhangs from debt restrain growth and effectively ultimately crowd out private sector investment. So the final slide on debt, this is just looking at how that collapse in money velocity has resulted in ultimately a deterioration in investment in capital stock and productive assets, just accumulates in the financial system and weighs on the potential growth of economies. So debt, a headwind to growth. Third D, deglobalization. So there are these long cycles of trade expansion and trade contraction. And so again, this is 150 years of history. And the chart that you see is imports plus exports divided by global GDP. So it gives you a sense of the importance of trade as a tailwind or headwind to global growth. And you can see there are these long periods where there's industrialization and integration, new technologies, better shipping technology in this case, that provide tailwinds to global trade and tailwinds to economic growth. You enter these periods of deglobalization, in this case World War I and World War II, where trade as a percentage of global growth falls for a couple of decades. Post-World War II, led by the United States with Bretton Woods and the guarantee of free global trade and fixed exchange rates at the time, global trade really exploded. The US provided open access to our huge consumer markets at a time that the markets globally were very dislocated. And as you'd expect, you saw an extended period of growth even after the fall of the gold standard. Ultimately, though, the political motivation behind this was partly geopolitical. It related to containing the Soviet Union. And as the geopolitical conditions have changed, and as demographic headwinds and the debt headwinds that we've just talked about have begun to create concerns politically, domestically within a variety of countries, there's been a pushback against these open markets as people want to protect their local consumer bases, protect their local industries in the face of declining global structural demand. And so you enter a period of globalization or deglobalization, and that's only accelerated by some of the populist movements that have begun to emerge globally, but it reflects underlying economic conditions, and it builds on the demographic and debt headwinds that we've just touched on, and it tends to play out over decades, not over years. Final D, disruption, which is a different term for innovation. The idea that in the context of slower global growth, demographic headwinds, headwinds from debt, headwinds from deglobalization, traditional businesses are also encountering challenges from innovative companies that are disrupting traditional business models. And so the scarce profit pools that are available and the scarce growth opportunities that are available are increasingly being captured by companies that provide innovative solutions leveraging new technologies. This is not just something that occurs in the US. The US tends to be very proud of and focused on Silicon Valley and our own innovative economy. But as you can see from this National Innovation Index, which is published by Bloomberg in this case, and it consolidates a variety of indicators, including things like patent formation and technical staff and research and R&D investment and a variety of other indicators. The US actually ranks 8th or 9th in the world, and many other countries have highly innovative sectors and industries and infrastructure. And so globally, there's a tremendous movement towards disruptive new business models that capture the available profit pools and the available growth opportunities. The pace of innovation is actually accelerating. So you can see this is a little over 100-year history of the adoption of different technologies. Some of these don't seem so innovative any longer, but it's worth just recognizing how long it took for people to really embrace the automobile or washing machines, or my favorite, air conditioning. These things played out over the course of decades. Innovation now is accelerated. So these are more recent innovations, and the steepening curves that you see reflect faster adoption of innovative technologies. So for example, this last one here is tablet computing, which is completely disrupted, among other things, traditional publishing, a very old technology. But in each case, you can see how quickly new technologies are now broadly adopted throughout society. This pace of technology adoption continues to accelerate. So a different example, a couple of examples in digital technology and software. It took Microsoft about 24 years, over 2 decades, to get to 1 billion Windows and Office users. So those are technologies, introduced in the 1980s, and it took over 20 years to get to 1 billion users. Google and Facebook introduced their services in the early O's and late O's. It took them a third as long. It took them about 8 years to get to 1 billion users. TikTok, in the news very much today, got to 1 billion users in just 4 years. So the pace of adoption continues to accelerate. We continue to see convergence between technologies, accelerating adoption of technology and disrupting traditional business models. One consequence of innovation, and this is an important consequence because it's going to relate to asset prices, is it makes a wage inflation cycle very unlikely. So on the left-hand side is a graphic that schematically presents labor market dynamics with the most skilled workers at the top of the pyramid, middle skilled workers in the middle, and the least skillful workers at the bottom. Technology, whether it's factory automation or AI and machine learning or other kinds of digital tools, tend to increase the value at the upper end of the skill pyramid and devalue or commoditize the middle range of skills. And so what that translates into is adjustments in wages across different kinds of sectors with information communication services, other science and technical skills, seeing some wage tailwinds, but more middle skill professions encountering some wage headwinds. The net totality of all of this is it makes a very pronounced or extended wage inflation cycle extremely unlikely. What does this mean, these 4 Ds that we've just talked about, demographics, the accumulation of debt, deglobalization, and disruptive new technologies? What does this mean for the price of equities generally? And then finally, what does it mean for growth versus value? With regard to equities generally, and this is going to be a little trip back to Econ 101, so I apologize for diving into this, but it's incredibly important. It's incredibly foundational to how asset prices are being driven at the moment. The 4 Ds are driving policy rates lower. So the primary policy rate, the rate that you'll often now hear discussed in the news, is the neutral or natural interest rate, sometimes summarized as R star. And that's the policy rate which balances full potential economic activity, so full employment, an economy operating at its full potential with no inflationary pressure. Put another way, it balances demand for money with supply of money. So that policy rate is the neutral rate, which perfectly balances those 2 objectives: a fully employed workforce, an economy operating at its full productive capacity, and no inflationary pressure, no deflationary pressure. Because of these aging populations who prefer savings and bid down Policy rates bid down the interest rate required to save and invest because they're saving for their retirements. They push down rates because they supply lots of excess savings. And at the same time, they push down the productive capacity of economies because they slow down the potential growth. They have slower consumption demands. Similarly, the debt burdens slow down the potential growth of economies. The unfunded fiscal expansions create a lot of excess money in the financial system, pushing down interest rates. Deglobalization slows the potential growth of economies. All of those different elements, technology and disruption, tend to be very deflationary. All of those forces combine to structurally lower the neutral or policy R* rate, and that's what we've seen over the last 60 years in this graph. You've seen the policy rates, which used to have to be quite high, even above growth to restrain growth, fall progressively down now to approximately zero, and actually have to fall below the growth rate in order to support growth because of all the headwinds we've just talked about. This isn't just happening in the US, this is happening globally. So this goes through 2015. If you update this, all of these policy rates would begin to be approaching zero. When the foundational rate, this is the basic rate on which all other risk assets are valued, when the policy rate falls to zero, it pulls down the rates for everything else. It pulls down the yields and everything else and pushes up the value of risk assets. What that means is real yields have now turned negative. This is a look across the developed world. They've turned negative, and history would say that they could remain so for a very long time. So these are real short-term interest rates, 1 year and less, falling below zero even before the recent turbulence around COVID, continuing to get progressively more negative. And these are long-term real yields in developed economies. And again, this goes back a long way and gives you the long-term perspective. Real yields can be negative for extended periods of time, even decades. And we've actually just entered a new era, the QE era, because that neutral policy rate, that R* rate has approached zero, the so-called zero policy bound. That constrains policy choices. If policymakers are trying to support economic growth, they have to get below the neutral rate to stimulate growth. But if the neutral rate is zero, that either means negative interest rates, which is extremely challenging, people are experimenting with that, or it means directly intervening in asset markets by engaging in quantitative easing. As you can see, these regimes, these policy regimes tend to unfold over the course of decades. We've just started the QE regime that's directly expanding the valuation of risk assets over and on top of the natural effects of a low policy rate. The Fed understands the 4Ds and has concluded that the bar for a sustained reflation, the kind of reflation that might give a little bit of a tailwind, at least temporarily, to value assets, it's very high. And so this is actually directly from the Fed, where they're relating in this case, demographic headwinds to the persistent declines in R*, the neutral rate. You could see similar kinds of discussions around the other elements that we've talked about. And the result is the kinds of statements that we saw out of Jackson Hole just last week or earlier this month, with an expectation that we're very unlikely to see a sustained inflationary cycle. So the Fed is essentially saying they're going to anchor neutral rates at zero for an extended period of time, because the 4Ds mean it's very unlikely we're going to see any kind of sustained inflation, and that's going to underpin asset values and asset pricing for longer duration risk assets. This brings us now to equity valuation and to the growth value question in a moment. If one looks at equity valuations, not simply through the narrow lens of price earnings ratios, but in the context of the generally zero or negative yields that are now being offered by all forms of risk assets, equities start to look extremely cheap. And specifically, if you look at the so-called equity risk premium, which is the yield you get on equities relative to the yield you get on risk-free short-term assets or credit or bonds, whereas the PE in dark blue makes equities look a little bit expensive, the equity risk premium, what equities now yield in terms of earnings and dividends and cash flows relative to what you can get from any other form of long duration asset, it actually is historically attractive. And the closer you look, the more attractive it appears. So for example, if you look globally rather than just in the US, the equity risk premiums look even more attractive. If you drill down and look at the dividends, 70% of stocks in the S&P are now yielding more than the 10-year, and the percentage outside the US is even higher. So if you look at the yields that equities now offer, we're at historic, and this is over 20 years of history here, even more so than during the financial crisis, we're at historic attractive equity risk premiums. And contrast that with just two other notes here, because any longer duration asset is going to be supported by zero policy neutral rates. So this is the term premium for taking long duration bond risk. You get paid a little bit for taking a little bit of bond risk, but not very much. It's below average. It's not especially attractive. This is investment grade risk. So you get paid a little bit more, perhaps not enough to justify the default cycle that we're facing, but it's nothing special, but it's better than zero. But the asset class that really stands out are equities. And it's not just in the US, it's globally. So you can see the major regions outside the US here as well, every single one of them at historic highs, underscoring the attractiveness of equities relative to other long duration assets in the context of zero policy rates. In fact, the equity risk premium is now at a 50-year high. So this is the equity risk premium relative to both treasuries and corporate credit. So relative to the primary alternative long savings asset classes, equities offering a historic attractive risk return. This brings me now to growth versus value. So that's the general comment on public equities specifically, but with regard to growth versus value, the 4Ds also go a long way to explaining why the growth premium is entirely justified and may in fact expand. So the 4Ds are deflationary, we've talked about that already, and lead to low rates, but they pressure economic growth. We've talked about that as well, the demographic headwinds, the debt headwinds, the deglobalization, all of those things pressure economic growth. And so as 10-year yields have come down, growth rate has fallen. This is for the US. This is globally. So again, we're always taking a global perspective. This is a universal phenomenon. The 4Ds, in this case specifically the 3Ds, but the fourth D as well, each one has pressured the general growth within economies, and that pressure on economic growth has also slowed corporate growth. And so this is revenue growth across the major regions of the world. Not only have interest rates come down and real growth rates fallen, but revenue growth has come down globally as well. So this is nearly 30 years of history globally. And what that's meant is earnings are lower than they used to be. In this case, this is S&P 500 earnings. And fewer and fewer companies are able to achieve meaningful growth. So in this case, it's companies able to achieve 15% or more growth. And we have only 13% of the S&P able to achieve that over the trailing 5 years, again, as earnings and revenue growth have fallen in line with the 4Ds creating pressure on rates. So propping up valuations, but making growth very scarce. Another way of looking at this, a global perspective, that was the S&P. Fewer and fewer companies globally are able to sustain high growth in the face of the 4Ds. So in this case, this is low growth is less than 4%, high growth is more than 8%, so 2 times as much growth. And as you can see, the jaws have really opened up over the last 25 years, with now, again, something like less than 15% of companies offering above average growth. And the majority of companies really struggling to grow even in line with nominal GDP. The growth premium, the premium that people are paying for growth values down, versus value, boils down to supply versus demand. So what you see here on the demand side is the valuation that people are paying for these high growth assets. It's rising as the availability of these high growth assets is declining. Makes perfect sense. And it's a global phenomenon. So demand for growth is rising everywhere, hurting value stocks. So you can see this is value underperforming growth as real growth and interest rates fall. And this makes perfect sense. This is completely consistent with valuation theory. In this case, this is a look at dividend discount model analysis. varying one critical variable in each case on the left and the right. This is a Morgan Stanley study in this case. On the left-hand side, we're looking at growth versus PE using a perpetuity dividend discount model. And as you moderately increase the underlying potential growth or sustained growth of operating profit in this case, there's a parabolic increase in the potential valuation of the enterprise. So increasing the growth rate by 10 points dramatically raises the PE multiple that you would pay for that stock, just using conventional valuation frameworks. In this case on the right, returns, to the extent that returns are higher for growth stocks, and we'll examine this in a second, again, a parabolic relationship. If you vary the potential returns from an enterprise, you pay a much higher PE just using a conventional valuation framework. Let's see what the facts are. Here are the facts. Growth outperformance is underpinned by fundamentals. Are we seeing higher sustained earnings growth? This is a growth index versus a value index. More than twice the growth, almost 10 points higher growth. Are we seeing higher returns? Yes, we're seeing more than twice the returns, more than 10% higher returns, more than twice the value. And frankly, we're doing it with lower leverage, which is also going to increase the amount of the value that is left over for equity investors. Another important feature that speaks directly to valuation, not only is growth higher return, it's also less cyclical. And because it's less cyclical, you value that growth at a lower discount rate. That's, capital asset pricing model, higher beta, lower, higher discount rate, lower valuation. So this is a style market capitalization matrix. And as you can see, the returns for growth stocks, this is large, mid, small, value core growth, the highest returns up in the large cap growth, but perhaps more surprisingly, the least cyclicality. And as you move into the value stocks across every capitalization, dramatically higher cyclicality. What does this mean over on the right? It means that value has become almost synonym for high beta. And there's an 85% correlation between value stocks and high beta. If you discount stocks using a high beta, it lowers the valuation. Similarly, the earnings and returns for growth stocks are much more resilient to the extent that earnings and returns are more volatile. You have to use a higher discount rate, again, lowering the present value of those assets. So whether it's looking at earnings resilience, both in the US and globally, with growth holding up much better in the face of shocks than value, and that's the case both in the US and in this case Europe, growth holding up much better than value through the shocks, or over time, providing persistently higher returns on equity through all different kinds of market cycles. For all those reasons, you have to apply a higher discount rate, you have to reduce the value of the value stocks. Present value of cash flows, growth stocks are generating far more free cash flow. These are free cash flow margins comparing the top 5% growers, the next 15%, and then the rest of the large cap universe. Significantly more free cash flow generation, providing net present value, and also sustaining high levels of capital return. So this is just an analysis in this case of the US. You could do similar analyses around the world, with the large growth stocks accounting for the majority of capital return within indices. Another feature of growth stocks that's underappreciated but supports the relative value, the attractiveness of growth versus value, is, and this speaks directly to these book value arguments, book value is very distorted. Growth stocks have all kinds of hidden assets. This is a tiny bit complicated, but I'll try to be succinct. This is a long-term analysis. This is 70 years now of breakdown of property, plant, and equipment for US companies. And the rising bright yellow line that you see on the screen is the total value of the productive assets. The tiny little darker zone that you see right at the bottom that you can barely even see perhaps is the intellectual property, the software, the data assets that barely show up on the balance sheets. Growth companies expense the development of their software. They pay the engineers off of their P&L. They don't capitalize that. They accumulate data assets by providing software and services to users, and they effectively barter for that data, which is their most precious asset. Those valuable assets don't end up being capitalized. They end up being expensed, and they represent a hidden asset on the part of growth stocks that vastly understate their real, if you will, book value or net asset value. This is just one example, the case of Facebook, with all of their software and data assets, which is to say the heart of the company, representing just a tiny sliver of their book value because they've expensed them all or they paid for them off balance sheet with stock options. So tremendous hidden value on the part of growth stocks that really upends any kind of a book value argument. In the end, the current growth value spread reflects an expanding fundamental gap in favor of growth. So again, long-term perspective, 40 plus years. This is the tech bubble. Those of you who, like me, remember investing through the tech bubble, one of the reasons that one we knew was a hype is the green line is the performance of growth versus value. The gray line is the fundamental profitability of growth versus value. During the tech bubble, the stocks went up, but the profitability was never there. And so you had these tremendous kinds of conceptual valuations that ultimately corrected. Completely different at the moment. The fundamentals, the fact pattern is different. The rise in the profitability, the returns, the cash generation of growth stocks is what supported the current period of growth outperformance. And so you can see the two lines moving together, very different. Growth is structurally more attractive than value. So this is a breakdown of the world indices. It's just important to realize that growth is on the right side of disruption. So growth is, this is the percentage in the index of the different sectors, and you can see what's overweight and underweight in the different on the right-hand column. Growth is dominated by information technology, which isn't really in value, and only some of the old disrupted companies like IBM show up in the value index. Consumer discretionary, which means e-commerce and new forms of reaching consumers. Communication services, which for growth is very overweight and means the internet. For value, it means old line tech stocks, old line telecom stocks, excuse me. And then again, innovative healthcare companies, biologics, biotech, not the kind of disrupted pharmaceutical stocks that are somewhat represented in value. What is value really overweight? These traditional financials that are extremely disrupted by fintech and other new forms of financial services that are really cannibalizing the most attractive profit pools, energy, utilities, traditional industrials. So all the kinds of businesses that are seeding profit pools and really facing some of the structural headwinds. Value sectors also are challenged because of regulation. A lot of the sectors that dominate the value index, in this case, we're looking at financials versus technology, the two extremes. Financials facing ever higher regulation, pushing down book value multiples. Technology, notwithstanding some of the headlines, relatively lightly regulated, supporting book value multiples. As you can imagine, the same can be said of energy and materials, also facing higher rising regulatory headwinds. So these are measures of regulatory intensity affecting different industries. One last point on growth versus value that's, I think, very topical. Growth scores much higher for ESG. We've been integrating ESG now for nearly 25 years, and it's something that increasingly others are focusing on as well. And growth stocks absolutely benefit from being better positioned with regard to the major ESG considerations relative to value stocks. And as investors begin to focus on the sustainability of enterprises and the alignment of enterprises, it's driving flows towards growth stocks, also supporting relative valuation. What does this mean? It means that growth, to conclude, has a long way to run. Long-term perspective, nearly 100 years of history of growth versus value. Too often people will show you just a short-term chart, a 3-year or 5-year or 10-year chart, but growth and value has been a feature of markets for a very long time. And value outperformed growth essentially from the end of World War II all the way through the financial crisis. So 66 years, this is from FAMA French data. And there were occasional moments where growth had a kind of a rally. That's when the line points down. That means you wanted to live in value, and vacation in growth was the phrase at the time. And occasionally there was a rotation into growth, but basically the tailwinds from rising population growth, accumulation of debt, you can see consumer debt binge, government investment, all of those things, globalization, were tailwinds that provided structural outperformance for value stocks for almost 7 decades. And it's really only a relatively short period of time as the tailwinds for value have become headwinds that growth has begun to recover. So we've only seen now 14 years of outperformance by growth versus value. Every one of the factors and forces that we talked about is going to unfold over the coming decades. These aren't short-term elements, these are long-term elements. It doesn't mean there can't be a temporary market, you get a short rotation into value and some kind of policy, headwind or tailwind. But the broad trends, just as they supported value for decades, now support growth and are likely to do so for decades to come. Good news with regard to a growth market, though, for capital allocators is while the 4Ds, the headwinds of demographics and debt and deglobalization and the challenges of disruption mean that the amount that markets will deliver just through raw beta will probably be lower. We'll have lower nominal growth rates, lower index returns. So that's the challenge, and it'll be important to, if you want to meet your actuarial rates of return, to get some active alpha, either through asset allocation into the appropriate factors or through ideally benefits from stock selection. This is from an elaborate Bernstein study. The good news is that growth investing actually has favored stock pickers. Identifying the subset of companies that can structurally outperform is the business of stock selection. And so this stock picking idiosyncratic alpha has really been concentrated into growth strategies. And I think that is a positive note as all of us try to navigate the current environment. With that, I am going to pause for questions and try to address a few of the questions that have been posted. So I'll just jump right in and do that. This, by the way, is our own history of growth investing. So what factors would potentially undermine the structural growth thesis that you've laid out? So each of the factors, I chose the 4Ds because they're very long-lasting in their nature. So again, no government stimulus program can suddenly manufacture new young people, new 20-year-olds. And so the demographic headwinds are going to unfold over an extended period of time. It's very unlikely that governments will suddenly solve their debt problems. If anything, things seem to be headed the other way as governments embrace money printing, so-called modern monetary theory and quantitative easing. The deglobalization trends seem to be accelerating. So I think it's going to be, a long period of tailwinds for growth relative to value. I think the disruption is accelerating. Moore's law means that we get a doubling of a lot of these digital solutions every 18 months. That means they get more and more compelling. They're more and more likely to cannibalize traditional solutions. So again, while there could be periods of rotation into value, we've certainly seen a few of those over the last decade, it hasn't changed the broader trends. So until we get a fundamental shift in the demographic outlook or the nature of debt funding or the other structural factors, I think there will be tailwinds to growth investing. And I think that does help with longer term asset allocation. How do you think the effectiveness of global versus regional mandates will unfold in the context of deglobalization? So again, I think one of the advantages of taking a global perspective in an increasingly siloed world is you are able to recognize the broader emerging opportunities. And I think when people are narrowly focused in just one region, sometimes they can recognize perhaps the best of the worst, but trying to contextualize things is much more challenging, and it's been an accelerating source of alpha for us having a global perspective. What is your expectation for real growth and returns in the coming decade in light of the 4Ds that you've articulated? Again, the 4Ds do suggest that we will be in a period of lower growth that will weigh on the potential nominal growth rates in the world. So it's likely that we'll see real growth that will remain at or below 3%, which has been the recent trend, the new normal trend globally. And we do see headwinds to inflation. It's kept inflation tethered below 3% also. So nominal growth, the combination of those two things in the mid-single digits, and that'll define for most companies their potential earnings and cash flow growth. And so I think mid-single digit returns for beta, and then obviously if you can be on the right side of innovation, you can potentially add alpha over and on top of that. As countries around the world attempt to meet the goals of the Paris Agreement, net zero carbon emissions by 2050, what does that do for growth versus value? Again, I think that's a very important challenge for a lot of the traditional business models that tend to be really on the wrong side of carbon emissions. This is such an important topic, but a lot of the innovations that are unfolding globally allow people to move away from dependence on carbon emissions. So some of those sectors that are very highly represented in the value sectors, like the extractive industries, like the traditional industrials, I think will be severely challenged, whereas I think some of the innovators in the growth sectors will be part of the solution. And so I do think it's another tailwind towards growth investing. Let's see, your presentation has provided a large degree of evidence for growth investing. What do you see as the primary risks to investing in growth equities on a forward-looking basis to ensure that you're not falling into confirmation bias? And this is so important. It's absolutely critical to continuously monitor and reconfirm all of the daily data flows. And so when we talk about the structural headwinds to inflation or the challenges to growth at a macroeconomic level, we're taking a very granular daily look at that information. At Axiom, we're ranking the economic releases for 100 countries. That's every developed, every emerging, and about 40 frontier countries, growth, national, balance sheet, and inflation. Every single day, we're scoring a positive, negative, or neutral. We're reassessing continuously whether or not the evidence is consistent with our macroeconomic framework, and of course, at a microeconomic level, assuring that our companies are well aligned as well. So that's something we do absolutely continuously. And one thing that it's meant is that in those moments of stress, when we've seen rotations into value, we've been able to take advantage of those opportunities because we could see that the thesis was still intact. I understand your one more question here. I understand your secular argument on the 4Ds, but on a cyclical basis, haven't earnings, ROICs, ROEs, sales leverage differentials historically compressed between higher beta value versus growth following recessions? So sure, this is essentially a question about short-term timing, and we've seen two significant, we'll call it reflationary rotations in the last 3.5, 4 years. We saw the so-called Trump trade in the fourth quarter of 2016. We saw a rotation to value for other reasons in the fourth quarter of 2018. And look, we are always looking for diversified sources of alpha because there will be rotations. But the reality is, even with those rotations, the compounded rates of return have vastly favored growth investing over value investing, and the recoveries have been equally abrupt. So that's why we continue to focus on the broader trends. I think we have time for one more question, and we have a couple more. I'll just quickly, just watching our time limits, but what impact do you think regulators, antitrust will have on growth in general, given the market leaders are all in the spotlight? So this is critical. So, again, we talked about the effect of potential regulation. I was highlighting its effect on banks and value sectors, but it could clearly affect certain growth stocks, including some of the high-profile social networking companies. Facebook and Google are in the crosshairs, for example. And the market understands that. If you look at the valuation of those growth stocks, they're trading below market multiples because people are incorporating those risks. And so people do differentiate between different kinds of tech stocks and different kinds of regulatory circumstances. But the broad picture is the growth stocks tend to be better aligned and less susceptible to those kinds of headwinds. And that is critical in terms of active stock selection. Just one last question, then I'll turn it back to Kurt for some closing remarks. Any thoughts on the increase of tech business staying private longer and the growth of crossover investors who invest in both public and private businesses? Again, one of the, it is an interesting feature. One thing that we're fortunate as global investors is there are tremendous range of opportunities available to us. And so we do find some of those very high growth, earlier stage companies within our universe and do take advantage and invest in them. The good news is we don't suffer the illiquidity and the high fees associated with the private markets. And so that is an opportunity that we continue to find a way to participate in. So with that, I think I should turn it back to Kurt for some concluding remarks. Thank you all for listening.
Well, and thank you, Andrew. And I did want to just thank our clients and trusted partners for joining us today. As I mentioned at the beginning of the presentation, the webinar will be posted on our website, which is axiom-investors.com. Please feel free to contact me with any questions. And once again, we want to thank you for your trust in Axiom.